Thank you everyone for joining. We will start in just another minute or two to allow everybody a chance to log in and join the session. We'll just start in another minute or two just to give everybody enough time to join. Thank you for those who have joined us so far. We'll start in another moment or two. Thank you to those of you who have joined us so far. Please do introduce yourselves to our audience and our guests, who you are, where you're from, what you do, what your interests are. And it would be nice to sort of engage in conversation throughout this conference. But I would love to know where you are all joining from, which corners of the world you're from. Hi, Rakli, nice to meet you. From Israel. Nice to meet you. Okay, we will give it just one more moment and then we will start. Okay, I think we will get ready to start. Just so everybody is aware, we are recording this session, and this session, the recording will be made available to all of our panelists and also to all of our guests attending today. You will receive an email with the link, so you will be able to reference back and also to share this with as well. Also, just to make everyone aware, we did have, this is a two-day conference. We are on day 2. I can see that there's a question that was sent to me regarding yesterday's conference. It was recorded and it will be, I'm not sure if we've sent out the link as yet. I will find out, but I'm sure that will be sent either today or tomorrow. So yes, they will be made available to everybody. Okay, we'll just start in just a second. Okay. Johnny Adams from the West Coast in the US, nice to meet you. Okay, for those of you who have just joined, we are recording this session. We do have a chat function at the bottom, and I would really like it if you would please do engage freely and drop a mention of who you are and where you're from, what you do, what your interests are as well. Okay, so without further ado, I think let's begin. Okay. Okay, ladies and gentlemen, good afternoon, or good evening, good morning, depending where you are joining us from. And thank you for joining us on the second day of this exclusive conference. My name is Yourofsky. I am a strategic advisor at Deep Knowledge Group, and I will be your moderator for today's presentations and discussions. So yes, it's day 2 of our event, which we call the InvestTech Innovations. It's a new quarterly conference for prominent industry figures to review and discuss the latest trends in private equity markets. This exclusive event is essentially your opportunity to explore the latest cutting-edge InvestTech solutions, to learn about the emerging multi-trillion-dollar deep tech and longevity industries, to access our breakout area here, to be able to network with your peers, and hopefully to generate your own potential financial leads as well. Again, this event is being recorded. It will be shared later for all to use for your reference and those that weren't able to attend as well. Again, we have a lovely chat facility below. I can see several messages from people saying hello. Hi, Anastasia from Dubai and Ryan from Ohio. Please feel free to engage in the chat. I would encourage you to leave your comments and to feedback about the speakers. And you will also find in the chat, there will be links directly that will direct you to the social media and to the websites for some of the speakers that we have today. So you will have an opportunity to follow up with them and also follow what they do and any articles that they are featured in as well. And I would like to kindly request that we have at the bottom in the far right, you will see a Q&A box. Well, if you have the same screen as me, please send your questions directly into the questions and answers box. Please don't send them into chat. They will just get swallowed up and lost in all the different messages. And if there is a question that you specifically want answering by a speaker, a specific person, please do add their name at the start, or if it's general, then we will try to get to that at the end of this session, where we will have a panel. As and when, if we are able to answer the questions, if they're quite specific, then I would encourage our panelists to try and answer some of them direct if it's more appropriate to do so. Okay, without further ado, I would like to introduce our first speaker. Nikita, so if I could ask Nikita and also for other panelists, as and when you are on speaking, please do have your cameras ready to turn on and to also unmute yourselves. And when you are not speaking, please kindly leave yourselves on mute as well. Nikita Bursanov, welcome. It's a pleasure to have you join us today and to start this the second day of the conference. Nikita is a quant analyst here at Deep Knowledge Group. He is a quantitative analyst and a former researcher in the field of matrix theory and control theory, which is ICS for us. And he's interested in financial models, including stock performance prediction based on financial and non-financial parameters. At Deep Knowledge Group, he provides quantitative analysis and performs market research, as well as developing pricing models. Nikita has a good experience in managing long equity portfolios, and he holds a master's in physics from MIPT in Moscow, and he's currently finishing his Masters of Finance at the University of Bologna. And I believe you are a CFA candidate as well, and you've passed 2 out of 3 of your exams with 1 pending, right?
Yeah, that's
congratulations. Wonderful. Great to have you with us, and the floor is now yours.
Thank you. Thank you. Can you see my screen?
Yes.
Okay, great. Yes, that's correct. I'm a quantitative analyst in Deep Knowledge Group, and I am presenting today the topic of alternative data in investment process. In particular, I will talk about alternative data for public equity, investment in public equity. Okay. So let's start from the definition maybe of alternative data. What is alternative data? Normally, when we speak about alternative data, we mean the data which is not coming from the insiders of company, which is not coming from, let's say, normal source of information like annual reports, quarterly reports, or press releases. So it's any other data that we can obtain about the business, about the company, about its financial structure or operations or core business or anything else that we can obtain from other sources. So the first question which we should ask ourselves is why we need this. Why do we need any additional source of information besides from conventional sources, which I listed before? First of all, I will just list 4 reasons, which are quite obvious, but let's talk about them. First of all, in financial reports, the management put the information they want to put and they are obliged to put. There is no way to make them put some information. For example, let's imagine that what they want to show the earnings of the company for a particular quarter a bit higher than they are, and they don't have any regulation that prohibit them from doing so. They can do it. They can manipulate it a bit, and it's very frequent practice. Alternative data can help to detect it and to take it into account when we make our investment decision. Completeness of disclosure, quite again obvious point. Typical private equity today is huge corporations with maybe several child companies with operations in 100 countries maybe, and of course one press release or one SEC filing which can contain even 100 pages is not enough to disclose all details of business which can be relevant to investor. Third thing is frequency. It's quite normal to know some news about operations, some material information about company operation on the date of SEC filing disclosure or annual report disclosure if we are talking about companies not listed in the United States. And of course, the events which lead to the numbers which we can see in this disclosure, in this filing, can happen before. And it's important to know about them before it's reported in the filing, in the annual report. And it can be a comparative advantage for investor to know something before other investors know. So in this way, we a bit touched the 4th point. All annual reports are extremely common to use among all market participants, among all investors. So as it's famous phrase by if I'm not wrong, Benjamin Graham, that successful investment strategy should be unpopular. It should be the strategy which not everybody uses. Otherwise, it will never be better than average. So if you want to outperform the market, you should probably think about source information which are maybe not available to others, but not took into consideration by others investors, or at least by most of the investors. So we should, of course, touch important point that types of information which we might be interested in, it can't be private material information, even if we can somehow take it from external sources. Some well-known mosaic theory, which is for example, referenced by CFA Institute or other organizations. Analytics should rely on public material information and non-material information, both public and private. So when analyzing data, we can collect by pieces some info about revenues, about future profit, about future events which can happen to company without breaking the law, without doing insider trading or anything like this. Let me provide a few examples of data which can be used as alternative data. A very popular thing when we're talking about some companies which are selling anything is foot traffic, which is number of customers entering the location. It can be tracked by geoposition on mobile phones, by sensors, cameras, by Wi-Fi networks, by connections to them of clients. Satellite images is very popular thing. As soon as we have more and more information, more and more photos from space, we can use them to identify factors which can be important for business. Just to give an example, we can see we can see different weather factors. For example, if some agricultural company, has visible from space clouds above its fields, we can make some conclusions about its future profitability. Just simple example. Website usage, of course, it's very important, and as well we can talk about some analytics from Google, from search machines like Google. If some name comes more and more popular, we can make some conclusions about it, about future revenues, maybe growth of the company, or clarity among users. And of course, social media posts, sentiment analysis, which can be useful as from point of view of understanding market sentiments, so how investors feel about this company. And on the other hand, it can tell us something about the fundamentals about the business itself. The sources from where we can take the data are actually unlimited. I just mentioned a few of them. Copernicus is a space satellite image project, which can provide photos of Earth observation data. And Twitter, LinkedIn, Facebook, I think I don't have to mention what is this. Refinitiv is the well-known company which provides, among others, good sets of alternative data which can be used for investing. Different types of data. They are in this business quite a while. Google Trends, which can help us to understand the popularity of some names, of some products. And SafeGraph, it's a database of foot traffic, if I'm not wrong. Yes, yeah, I think so. So I'm sorry if I'm wrong. I just yeah. Okay, one particular example of alternative data which is very popular nowadays is ESG. ESG parameters are collected into ratings, into some ESG reports about companies. They are taken into consideration by a lot of investors all around the world, and we have reasons for that actually. First of all, ESG is a popular topic, and of course, people are thinking about it. People try to be, try to make their investments maybe more ethical, maybe more bringing some benefits to society in general. Also, ESG can be a good indicator of business itself, because as I will say here, yeah, maybe let's switch for a second. 60% of typical ESG weight, ESG rating is based on governance of the company, and of course, the governance of the company is the very important criteria of how business is running, of how good is business. Is it capable of making profits above average, or it's not? So even for investor who just wants risk-adjusted return and doesn't care much about climate or social factors, it can be useful for him to evaluate ESG parameters. There are some screenshots from Safe Institute ESG guide, which you can find some factors which are into ESG, typical ESG report, typical ESG evaluation. There are weights of these factors. Maybe we'll not talk about it for long. You can take a look. It's maybe interesting. Especially maybe it's interesting because ESG often is perceived as green, something connected to environment. But in fact, it's more about different things. Yes, environment, of course, it's important, and of course, they take into consideration the carbon emissions and all these things. But I can say that way of managing companies takes more weight in typical ESG rating. So maybe to conclude, I would say a few words about how actually our ideas about ESG or other alternative data that we do for a company can influence our decisions on buying or selling. Actually, there are three channels how alternative let's say how the way company makes business, how the way it governs itself, how the way it makes business comes into the stock price. First thing is cash flow channel. I took this picture from the paper about foundations of ESG investing, which can be actually used for any can be extended to other alternative data. So I will say here about ESG, but you should keep in mind that you can add some parameters here. Strong ESG profile is typically leads to more competitive company because of good governance, because of effective supply chains, because of loyal workers, because of maybe good compliance with regulations, and it leads to higher profitability of company. In this simple way, makes business better, higher dividends, or higher growth of capital in case the company doesn't pay dividends, for example. So it can make company more valuable in this simple way, making business making more money. Idiosyncratic risk channel shows us the different thing, which is also important when you invest. Think about tail risk, about the possible drawdown of stock time series. Typically, company with good governance, company with efficient management, with strong ESG profile, has a good risk management as well, and manages risks which are important for its business. So we typically can say, and some papers confirm this, that company with strong governance, with strong management, are typically having lower downside deviation, you can say. So they are typically falling less than other companies in case of some negative events, which is of course important for risk-adjusted metrics. If we have lower risk of this company, all our investments seems to be better. And the last one is valuation channel, which comes from first of all from bigger investment community, which are interested. You know that a lot of big funds are require some standards from company. So if the company can correspond to the standards, it typically have a lot of demand for its financial instruments, for its stocks, for its bonds, it doesn't matter, and has a lower cost of capital, lower interest rate used in discounting cash flows or anything, and have just higher price, higher valuation by investors, which in the end can lead us to higher stock price and better performance of our investments. So to conclude, I should say that alternative data is very important and not maybe very not very good explored way of evaluate company, mainly because it requires, of course, dealing with big data, dealing with a huge amount of data. We should analyze, I don't know, foot traffic. Of course, it's not a Excel table with 20 numbers. It's millions and millions of data points, and we should be able to analyze them quickly to make conclusions, and probably analyze not only one company at the same time. So this is the area which can bring us a lot of insights into business, which can make it more objective, make it more, make the evaluation more objective, remove the reliance on management honesty or anything from our idea of how business working. We can evaluate it more objectively, more maybe efficiently, more honest, and manage our investments better, have higher returns, understand better what exactly we are investing in, and be less exposed to any kind of manipulations or inaccurate information provided in press releases or financial reports. Thank you very much for your attention. I finished for today.
Wonderful. Thank you so much, Nikita. That was really insightful, and I'm looking forward to addressing some of those points later during our panel. Thank you to all of those. Thank you. Thank you to all of those who have also just joined us. Just to make you aware, this session is being recorded, so you are able to have this sent to you later as reference. And also for those that weren't able to attend yesterday's session either, you will also be able to access that recording too. Also, please pay attention to the chat box below, where we will be sharing with you details that relate to some of the speakers, from their profiles, their socials, their Twitters and LinkedIn profile links as well as other details such as a link to the big data analytical system. Thank you very much, Tanya Bell, for sharing that for us today, with a lot more of the statistics and references that came from Nikita as well. So on to our next speaker. I'm very pleased to present Alexander Yourofsky. He is a project manager at Deep Knowledge Group. Alexander is a mathematician with a pharma background who is focusing on leveraging big data and machine learning in order to create predictive analytics and database market insights for longevity financial advisors, which you will also hear from later on today. Longevity Financial Advisors is the world's first, longevity-focused capital advisory firm, combining different ML-based approaches, and he also leads on the next generation of customized IT platforms for venture capital and private equity. Alexander is interested in mathematical and AI applications in investment, finance, banking, and also other areas. And I believe you speak 6 languages fluently, which include Chinese, Ukrainian, and German, which is amazing. Right. I wouldn't expect anything less. Thank you so much for joining us today, and I'm very interested to hear what you've got to say. Thank you.
Okay, let me share the screen. Give me a sec. Okay. Okay, so thank you everyone, and thank you, Nikita. My name is Alexander, and yes, mentioned, I'm a project manager at Deep Knowledge Group, and my today's talk is about alternative data and how we can use it for private companies. So as was mentioned, alternative data might be used in different cases, yet it might be complicated to use satellite images or foot traffic all the time. Fortunately, there are other types of alternative data that might be useful when investing in private companies. Another complication that we might encounter here is that albeit public and private companies have alternative data, that's for sure, but we cannot approach these companies in the same way, not only because due to the financial aspects, but also because the alternative data itself differs for public and private equity. So another problems that we have is that data scarcity in the case of private companies is much higher. The private companies are startups most of the time, which leads to absence of cash flow most of the time. And funding is one of the main financial metric, tends to be deceiving in many cases. What are the solutions, to these problems? First and foremost, most of the time, there is no need to approach private companies the same way we do with the public companies. For the data scarcity, hopefully and fortunately, we have alternative data. The same can be said about the funding. We can use alternative data in technical due diligence in order to overcome this problem. And as for the absence of cash flow, is technology due diligence that can shed some light on what's going on with the company, what are the prospects of the given company and its future. So when we're talking about data, most of the time right now, as was mentioned by Nikita earlier, we're interested in big data, right? So I did a small case study for you just to see whether it's possible, to aggregate big alternative data. So I've chosen the cancer vaccines as a topic. Most of the time when you work with alternative data, one way or another, you end up in a situation where you need to apply a natural language processing and ML technique, which allows you to, go through the text and extract certain relations to understand what's going on in the text, in a news article or scientific article and anything else. Let's imagine that our, algorithm is capable of extracting around one relation per 100 words. It's not that great. Many algorithms, in fact, can do much better. But let's say we use something simple. According to Google, we have around 1 million articles for cancer vaccines, which leads to the 5 million relations if we would use this algorithm, right? And definitely that's obvious that we would exclude certain, relations, but still we will end up in a situation having around, 100 or 200,000 of relations, which is most of the time pretty enough to feed to any machine learning algorithm, even if it's a greedy algorithm. This is for the volume. So sorry, just forgot to mention that when we're talking about big data, we are talking about it in the case of 3 V's, so-called 3 V's framework. So it's volume, velocity, and variety. So we're good with volume, right? We're good with the relations. As for the velocity, we have 72 news being posted on cancer vaccines topic just on Saturday, Saturday evening, which is around, every 20 minutes. So it's pretty high frequency data if we would compare it to the, let's say, hourly updated stock prices, right? So it's quite great. And as for the variety, hopefully, especially compared to the, let's call it the direct data, for alternative data, we have tens of types of data. But this leads us to another problem: how we should gather this data, how we should streamline this data, right? How we should assess this data, and how to derive meaning, from this data. So, in order to get value from the data, we need to think about 3 things. It's not like the truth itself, but it's something close to. So when we're thinking about the data, and we should begin with the data always, if we're thinking about machine learning and application of machine learning to any area, we should think about the intelligent data aggregation, and we should apply strict data management pipeline. And I would like to insist on this data management pipeline, because without understanding what's going on with your data, you won't be able to use it in any case. After that, we need to apply natural language processing and so-called classic machine learning. It's not a scientific, approved definition, classic machine learning. But by classic machine learning, I just mean certain techniques that tend to apply rather numerical data in order to, derive certain conclusions rather than textual data. Why we need this? Once again, because alternative data, most of the time, it's not a numerical data, right? It might be a photo, it might be some text, it might be, video, audio, whatever. So it might be something that is not yet, not yet transformed to the numerical form. Then we need to derive meaning somehow, right? So for this particular purpose, we need to use a experimental approach. An experimental approach, what does it mean? It basically means that there are no such thing as predefined way of assessing the information, or being sure that certain result is actually the result you're looking for, right? So you need to build hypothesis, not only statistical hypothesis, scientific hypothesis. And in order to build such hypothesis, you need to deeply understand what's going on with your data. Is it meaningful to use certain data in order to predict certain, certain behavior? And this once again implies that you need to have very strict data management, because since you try to use alternative data, right, you end up in a situation having different types of data. When we work with something financial, and numerical data, it's one way or another, already defined why this particular data, why this particular metric has sense. But for alternative data, no such predefined thing exists. So you need to do this yourself. And this once again leads us to this data management pipeline. That is really important when dealing with alternative data. What types of data we can use anyway? So this graph, this picture, it's definitely not the best visualization of alternative data we can use, and definitely it's not like the whole list we can use, because we can use probably whatever data you want. There are no restrictions unless it make any sense. But I've just tried to comprise certain points and examples of the data we can probably use for different cases. So first and foremost, it's economy-related data. By economy-related data, I do not mean any let's say GDP price, GDP time series or something like that. It's more about the policy. So for example, ESG, it's a great example, right, of the policy that different companies seem to apply. And this is definitely a great example of alternative data and how we can use this data in order to predict the future development of the company, to assess it somehow. Then finance related. So as for the finance related data, here we have different types of time series, that's for sure. But it's obvious that all of us tend to use financial time series. That's what we do in finance. So here I rather mean certain time series that are not financial time series by definition, but that have certain correlation, with the financial time series. For example, there are certain correlations between the average temperature and the average temperature growth and productivity of the workforce, right? There are certain correlations made in the same way, not with temperature, but with humidity and many other things. So basically, these are the time series we might be interested in when analyzing alternative data. Then knowledge-related things. Basically, that's pretty easy. It's IP, any type of IP. It might be IP by definition, meaning the patent, or the scientific article, but it also might be any type of article or, information that is produced by a given company. And at the end of the day, it's business-related things. It's, as an example, might be news, but I don't want to, narrow this in too much, because it's not only about news articles like press release, because press release is rather direct data. It's more about, let's say, Facebook comments, or more about Twitter threads, or I don't know, Instagram posts. So it's something that is related to how business is perceived by other people, by customers, potential customers, or by by people who are against this type of business. And for example, I'm pretty sure Philip Morris have a lot of them. So you need to assess their point of view somehow and do it numerically. But when we think about alternative data, why don't we use only humans, right? So why don't we just hire a couple of guys and say, okay, there is a task, you need to provide me with some understanding of what's going on with a given company based on alternative data. There are basically a couple of things that might be done better by machines. For example, a machine had higher data aggregation volume, but at the same time, people tend to have better data strategy, right? Machines can combine what cannot be combined, meaning that they can do this because of for example, data volume analysis, right? So a given machine can go through let's say, millions and millions of data points in a matter of seconds, which is impossible for human. I mean, probably it's possible to, scan through, but without no minutes, so we cannot do calculation this fast most of the time. Also, but at the same time, humans tend to have meaningful results when they do their work, and we definitely do not have any black boxes. So we can describe and we can show how exactly we came up with a certain idea most of the time. Moreover, machines can be described, not moreover, but in general, machine can be described as jack of all trades, right? And at the same time, humans are rather narrow experts in specific areas. So it's better to say that we need to apply, we don't need to compare humans and machines. We need to use them jointly. So it's not the human versus the machine, it's rather the human and the machine. So the point here is that we cannot exclude, at least for now, people and analysts from the data aggregation process or data management process or data analysis process. So alternative data cannot be fully, let's say, analyzed and fully governed by machine only, while certain direct data, let's say stock prices, it might be, yeah, you can probably create a certain, policy that will be, applied by a machine, so machine learning algorithm, for example, in order to create certain data insights, data-driven insights, and you don't need to interfere in this process anymore once you have created it. With alternative data, unfortunately, as for now, we cannot do it this way. So how we could apply this data? So basically, it's a great example with the public traded companies, but I will talk about private too. So this is a great article by Peter Hayek and Joseph Novotny, where they have applied natural language processing, namely they have applied sentiment analysis, as far as I recall, in order to predict gold prices, and then they have created a trading algorithm that uses these sentiment analysis only from 5 sources, as far as I recall, in order to make decisions about trading. And it can be seen here that basically their algorithm called Furia outperformed all other approaches, and most of them quite significantly, and had generated a average annual revenue around 24%, which is great, yeah, right? But how it can be used for private companies? So first and foremost, it's more efficient M&As and allocations by VCs, family offices, syndicates, whatever you call it. After that, it's niche markets. They would get more attention, including the financial attention, and it's a big problem for people to get into the niche markets, because most of the time it requires high level of expertise, and not all VC funds are capable of hiring, let's say, 10 chemists in order to understand whether a given company is a great investment target, an expedient investment target or not. Right? But definitely the future development of the alternative data for private equity, private companies has certain drawbacks. For example, we might end up in a situation having even higher data scarcity, because if a given company, let's say, understands that, okay, we cannot be private anymore, and be safe from the let's say competitors' data aggregation, they are able to extract meaning even in the cases where direct data is absent. So they might, implement certain informational policies and clothe themselves even more, and do not post anything and do not interact that much. But it might be not the biggest problem. The biggest problem might be the information-based biases and threats. For example, as data pushing, right? Since alternative data compared to the direct data in the case of private companies has much greater amount, it's much easier to produce such data, there is a high risk that a certain company might producing the information that is not only it's not only objective information, but it's also like it's definitely poisoned, right? And this might create certain biases when try to implement certain assessment models for private companies. Okay. We at DKG are not only interested in this type of thing from the theoretical point of view, but we also trying to build our own models. And I wanted to show you something that we have built and how it works, in order to make a, let's say, a showcase, a case study for you based on our development. So basically, we're interested in the creation of an algorithm that's capable of analyzing private equity. We are gathering around 170 parameters, and then we build around 10 unique SWOT metrics. We visualize it as a SWOT, as you can see here. Why this is a great thing? Because we can create a multidimensional comparison of the data. We can analyze everything from team composition up to economy-related metrics, the scientific advances, the trends of the websites, whether people like their website, whether a given company is popular among their target audience or not. And definitely it helps us to optimize data aggregation, because as I mentioned before, it's really hard to make some analysts to go through 1 million scientific articles or 1 million news articles and derive some meaning and do it in a matter of days. But for NLP algorithm, it can be done in a matter of hours, right? So this is definitely a great thing. If you want to create something that is capable of assessing private companies based on alternative data. So how exactly this can be applied, and for which cases this can be applied? So 4 cases mainly: funding, due diligence, business development, and competitors analysis. So as for the funding, we believe that this approach, this application of alternative data for private companies could help startups and any other companies find investors with greater ease, because it's much easier to pitch your product or pitch your company if you are able to show a multidimensional comparison and say, hey guys, we are not only good at business development because we have found you, or we are not only cool because we are doing a great thing, we also are much better at economy, we're much better at IP, we're much better at many other positions. And if it could be analyzed holistically, this creates a certain framework other investors might benchmark you with, and basically made a more quantitative, more data-driven decisions, as it is done right now for public companies, public equity, right? At the same time, for due diligence process, it's much easier for investor to use certain alternative database framework in order to analyze companies. So, for example, in our case, we only have like 170 parameters, and it's quite a task for anyone to write down these parameters first and foremost, and then gather the information. Because when you're trying to analyze company, you're not only analyzing one company when you're doing due diligence, right? You analyze a number of companies in order to understand whether this company, stands out in comparison to its peers or competitors, right? So using alternative data, using machine learning, it's possible to analyze multiple companies at the same time, and spending around a couple of minutes. So this is really what saves investors their time, save their money. As for the competitors analysis, as for the companies themselves, right? So there are 2 applications: BizDev and competitors analysis. So for the companies, if they have this multidimensional framework, it might help them find their value proposition. And we do believe that market research can be, ameliorated and enhanced significantly by companies employing different types of alternative data frameworks, because they might understand their competitors better, their peers better, and understand what is the product they want to create and want to sell. And the last but not the least is definitely collaboration between the companies, because it's really important when you launch in a startup to understand who might be your friend, not only competitor, right? In order to, for example, create a GV or create a, make an acquisition if you have money, or, merge, to create more resilient market player and, make better business. Okay, that's it. I really appreciate your attention. Thank you, everyone. If you have any questions, feel free to ask them.
Thank you very much, Alexander. Very, very grateful for the time that you've taken and the effort to share your thoughts and experience with us. And of course, we will be able to return and discuss more about your key points during the panel session later on today. So now I'd like to move on to our next speaker. We have Dominic Jennings. Hi, Dominic.
Hi.
Yes, hello. Hi. If I could ask you to turn your camera on.
Yes, certainly. Just
Lovely.
1 second.
I will introduce you. So we have Dominic Jennings, who is the head of strategic partnerships at Longevity Financial Advisors. Dominic is based in London and he has held several positions in financial services companies for over 20 years. He began his career as an investment banker, then co-founded an investment management boutique before establishing his own consultancy advising fintech and insurtech clients. And as I mentioned, Dominic Jennings is the head of strategic partnerships at Longevity Financial Advisors. And we're very much looking forward to learning more about Longevity Financial Advisors and also your input in today's conference. Thank you very much.
Thank you very much indeed, Roxy. And good afternoon, everyone. I thought we'd start today just with a quick review of the current state of the longevity industry. This is, as I'm sure you appreciate, what we'd like to call the world's newest asset class. The total market was valued at $25 trillion in 2021. And we see this rising to around $33 trillion by 2026. It's a large universe, 50,000 companies, not just in life sciences, but also in fintech, age tech, and various, many subsectors that you'll see later on in the presentation. There are 9,000 investors involved, 1,000 R&D hubs. But this mega trend of humans living longer and healthier lives will have a profound effect on many sectors, particularly life sciences and tech-enabled solutions with them, but also on the development of a longevity financial ecosystem. And just to remind, there are already 1 billion retirees in the globe at the moment with access to $15 trillion of assets per year. So this is not going away. Now, although 95% of longevity companies are private, there are, however, 500 publicly traded longevity stocks. And at the beginning of 2022, their market cap reached $5.5 trillion, which was up 18% from 2021. You can see from the pie chart here that the most dominant sectors are P4 medicine, farm tech, and telemedicine. Now, we still see a healthy investor demand for longevity IPOs, and 15 longevity companies successfully raised funds. This slide provides a review of the funding by name and sector, and also, unfortunately, highlights the dominance of the US as a preferred listing destination, which has been a trend in the last years. For the next couple of slides, we see that despite the downtrend in the global market since the end of 2021, we do expect interest in biotech to accelerate this year. There have already been 13 IPOs in the first quarter, and also we should note the healthy contribution from the UK. In terms of the future, we're looking at the pipeline looking strong. There are still nearly 400 longevity companies who have announced or are expected to announce themselves as potential IPO candidates. So that's a little review of the current state. And now, if I may, we'll turn to Deep Knowledge Group. Here we have the description of the Deep Knowledge Group and a graphic of our financial activities and analytical subsidiaries. Now, what I'd like to highlight in this particular slide is the group's USP, which is our big data, analytical and research expertise. The profound and speedy changes that we've seen in the last few years in tech and biotech life science need to be serviced by an innovative, advanced analytical platform, which our subsidiaries provide. DKG and the analytical subsidiaries is a world leader in analytics for deep tech and longevity industries, using big data, AI and ML algorithms, learning, for smart networking and forecasting, and offering 3D visualizations. And just to remind, this is all open access, open source. We also produce COVID-19 reports and the fantastic newly released longevity journal, which gives a full description of the industry. I think the important thing to remember is that these subsidiaries are knowledge engines, and they cut through the very complex and multi-dimensional aspects of the longevity industry and drive the investment strategy and therefore the client offering of the group. We'd also, just to highlight, want to point out that we can use this experience, and we'll be doing it in the near future, to establish the first ratings agency for the longevity industry. Just a few examples of the big data analytics. Here we have the Longevity Investment Big Data Analytics Dashboard. This provides the most up-to-date investment data for financial longevity, R&D, longevity medicine, and longevity tech. It works for both investors and corporations, as described in the lower analytics box, and provides screening, mind maps, data visualization, and all manner of parameters, comparatives, and reports. Similarly, the Deep Pharma dashboard provides a similar service of advanced marketing business intelligence for the pharmaceuticals and healthcare industry, using nearly 5 million data points. And there's a key focus here on AI for drug discovery, emerging therapeutics, precision medicines, and vaccine developments. And it comes with powerful data mining and visual interactive tools. Finally, as an example, we'd like to introduce the Investec Advanced Solution Platform, which heralds a new era in investment analytics. It provides investment recommendations and due diligence for deep tech startups, as well as publicly traded companies. For VC investors, it can identify the most promising targets. It can provide investment strategies for public markets, as well as valuations and designing new financial instruments. I should just say at the bottom of these research charts, you will see the websites. So this is Invest Solution, and you will see the link in the other slides. So on to our activities and projects. So as I said, our big data analytical expertise provides a foundation for us to build a comprehensive financial infrastructure for the longevity industry. And we seek to match the innovation of and speed of the industry by offering innovative products and more liquid tradable solutions for investors. I'll be talking about most of these products as we go along. I suppose what we should do, is talk about our track record. And Deep Knowledge Ventures was founded in 2014 in Hong Kong and was one of the first investors in silico medicine, which was a pioneer in the AI in pharma sector. This is where computational designs are used as an alternative to animal testing. The performance of the AI in pharma helps companies bring quick solutions through clinical trials at a fraction of the cost and time. And I think as the pioneer, there's obviously more information about the solution that in silico medicine came up with in its various trials and funding. But I think to show the investment track record, we look at the valuation, which is increased by 70 times over the last 7 years, as a good indication of Deep Knowledge Ventures expertise. Now, some of the products that we have currently are called actively managed certificates. And these are, Anastasia has provided us with a great description of the advantages in dealing in AMCs in terms of their flexibility and cost reduction. AMCs are structured products which allow investors to track an underlying index or basket of stocks, perfect for investors seeking exposure to individual niche sectors within the longevity industry. We work with our partners, Arian Capital, Bank, Vontobel, and UBS on these products. I should just give you an indication of the possibilities of AI and pharma opportunities. If we look at this slide, you can see that the number of AI pharma companies only 5 years ago was 11, and investors were 30. And now, if I remember, I'm afraid I can't see the figure, but I think the pharma companies are 300 now, and the number of investors and startups has greatly increased, 20 times industry growth. So at present, the actively managed certificates we offer are an AI in pharma solution, which focuses on the basket of stocks for AI in pharma. Who are working on precision and personal medicine to reduce costs and time to market using AI and computational techniques rather than animal testing. Excuse me. We also offer an AMC on cancer vaccines. Using deep pharma intelligence, we analyzed over 150 companies, private companies, and 35 public companies to make and establish a basket of 13 stocks, which we believe will benefit the most from cancer vaccine developments. In the coming weeks, we will be working with our partner UBS, and we hope very much to launch a longevity AMC in partnership with them. This will provide us and investors the opportunity to track a longevity index through an AMC vehicle. And the index is likely to consist of between 150 to 300 stocks. And of course, we have to construct an index for this. And in that regard, we are in discussions with Morningstar to finalize the index. We're looking at the methodologies, the constituents, and the weightings. So this is a future launch in the very near future. AMCs are extremely easy to launch. It usually takes between 1 and 3 weeks to launch an AMC. And if anybody has been in the investment management business, we all know how long it takes, how much longer it takes to launch a fund type vehicle. So the choice is unlimited in our universe, and we hope to bring more AMCs to the market. Other proposed products will, of course, with indices, include ETFs, a variety of indices on the industry, and I think most interestingly, a hedge fund, which could use our research and investment capabilities to go long and short on a variety of selected companies. And this will be the first short-selling instrument hedge fund in the industry. So we're very much looking forward to speaking with potential partners and colleagues about this, the setup of this particular instrument. Just moving on. Now, the Deep Knowledge Group is looking at one of the fastest growing investment techniques and making sure that we have exposure to this technique and offering clients exposure in the longevity space. If we look at the VC market, we all know it's been booming for the last many years, but last year was a record year. And non-VCs are looking for ways to access this market as well. One of the problems in the longevity industry is that traditional VC funds and investment tie up too much capital with little opportunity for exits. Our SVP platform will provide a solution for investors seeking targeted investments on a deal-by-deal basis, allowing them to make multiple investments in companies at different funding stages. This is very much a new platform, and we will be providing the onboarding, reporting, due diligence, legal tech, and reporting on the digital platform, fully automated. So it's a new innovative way not only to invest, to use the platform to help onboarding, to help the process of investment. And I think most importantly, it's effectively another innovative hybrid financial product, whereby if you use the SPV platform, there will be an opportunity for companies to access capital, but equally for investors with a possibility to offload some of their investment exposure in a quasi-secondary market. Going on from SPVs, there's quite a large presentation on longevity card that I have, but I thought I'd just use one slide as we're pretty limited in time. But another innovative product we're thinking about is under the banner of health is the new wealth. We are bringing to the market a longevity banking card. We're treating it as a vanguard product to explore the longevity banking and financial services market and to build a brand. It will have the traditional account features that's shown. We'll offer you new ways to lead a healthy lifestyle and manage your money in one secure app. The emphasis will be on efficient money management, well-being with points and rewards, fitness trackers and LinkedIn, linked apps. And also it'll be a one-stop shop through longevity marketplace of the best health and wellness brands in the world, up to 80 so far. So users will fulfill KYC, normal KYC and registrations, and we will build a brand through the marketplace, through the well-being, and through the marketing and links involved with card and providers. And hopefully we will be soft launching this in the next few months. Now, here's another interesting slide. Of course, our fundamental goal really is to move from being a longevity advisory niche boutique here at LFA and within the group, but to move to create the world's first fully licensed longevity investment bank. And here we will provide a platform to service corporations and investors to trade longevity, financial assets and instruments. Clearly, we are backed by the world's leading big data analytics. We understand the innovative developments in health tech, biotech, and longevity. And therefore, with our experience and research, we can provide the most suitable investment products and services. Who would benefit from this? Who could benefit? Well, excuse me, I think there's a wide-ranging appeal from corporations and investment funds, private banks and wealth managers, to pension and insurance companies. The nature of the innovative tech could also provide synergies with challenger banks and online brokers. We would like to clearly offer the full scope of investment bank services to clients as illustrated in this table. Finally, We also furnish an ambition to create another world first, which is a thematic longevity stock exchange. I think the best way to think of this is how NASDAQ grew in the second half of the 20th century to represent the tech industry and the growth of tech 1.0, maybe even 2.0, up until the 21st century. And now we're looking at a longevity stock exchange to carry through the longevity industry and all its various subsectors and companies and listings into the 20th century. We provide startups and smaller companies with a listing and access to capital, whilst also protecting investors with a recognized regulatory framework. It would attract a diverse pool of investors via a wide range of asset classes. I should also say that our ambition also matches and mirrors the UK government's recent long-term vision to ensure that the UK life sciences sector is properly supported and financed and helped by the City of London. Otherwise, we get the inevitable takeovers and listings on the US for our homegrown life science talent. We are in discussions with several recognized exchanges and are very excited about the possibilities of becoming a global hub, building a community of investors, companies, and advisors. So just to conclude, I hope you've got a greater understanding of our current activities and our future ambitions and strategy. And if you have any questions, please don't hesitate to contact me. I'm sure my contact details are available. Thank you.
That was wonderful. Thank you so much, Dominic. Really, really enjoyed just all the various different projects and products that you shared with us. If everybody would like to have a look in chat, you will see that my colleague Tanya Bell has very kindly shared the links direct to a lot of these products and services for those who are interested in learning a little bit more about it. Dominic, thank you so much. And of course, we will be coming back later for the panel if you are still with us. Yes, so let's move on to our next speaker, and then what we will do is have a very short break. So now I just want to see if we have you with us. Nikolai, are you with us?
I'm here. Yes.
Hi, Nikolai, hello. So now we have Nikolai Dovzhenko. Nikolai, a very warm welcome to you. You are an experienced corporate lawyer and project manager here at Deep Knowledge Group. And I believe you are a fully qualified lawyer and a seasoned top performing legal professional. And you have, I think, a decade's worth of experience in various different legal assignments within the investment funds industry. Your background also combines working at law firms, fiduciaries, and in-house, so VC companies, private equity, asset managers, and other financial institutions as well. And having a substantial formal education and legal training, you are now based here at Deep Knowledge Group, and you provide us with legal assistance across all subsidiaries. Nikolai, it's wonderful to have you with us, and I'm very much looking forward to hearing your presentation.
Thank you very much, Roxy, for this detailed introduction. So for the sake of time, I'll keep it short because I know we are a bit behind the schedule. Right, so let me just share my screen and let me go through the presentation I have. So I trust everyone sees my screen.
Yes, thank you.
Amazing. So what I wanted to talk about today is about trends on the fiduciary market and also investing into SPV business. So thanks to Dominic, he basically covered partially our intentions for this SPV business setup, right? So I'll focus maybe more on fiduciary market and partly talk about SPV business as well. But what I would like to see maybe actually provide more food to everyone's thought and raise more questions than providing answers so we can take it further at the panel. So if we are talking about venture capital fundraising dynamics, you can see the table here, right? So it was growing dramatically since 2020. And here is the data of 2021, but eventually in the first quarter of 2022, the investment size was a bit smaller in Q1 in comparison to Q4 of 2021. It's due to global crisis and geopolitical situation. So, but the tendency is still there. So when we're talking about fiduciary markets, so what do we think about? First of all, we think about funds, we think about trusts, we think about investment vehicles, right, securitization, etc. And so within this industry, as we can see, it's pretty resistant to any type of crisis, especially when you're talking about different financial hubs like London, Amsterdam, Frankfurt, Luxembourg, Singapore, and so on. So within this jurisdiction, we can find a lot of opportunity to grow and benefit from if you're talking about fiduciary business, right? When you take someone's money or when you manage them, when you manage their corporate entities, and etc. So if you see also on the global scale how the fundraising dynamics were developing, so these are information only as per Q4 2021. As I said, in Q1, it was a bit less of the year 2022. So if you're talking about SPV fundraising mechanics, so on the slide, you can see a lot of bonuses, how it works. But from my personal experience and what I can present, that SPV is very flexible. So SPV can be used for different purposes, starting for, as a commercial company and ending up with a securitization vehicle, right? You can do securitization, you can do tokenization, you can have SPV regulated, you can have it unregulated, you can create as a fund, you can create different compartments within the SPVs. And so having this flexibility and combining that with deep technical knowledge and artificial intelligence and big data, this actually opens a new scale how to grow your investments, how to plan them, how to structure them, how to enter new markets, and how to efficiently exit your current portfolios. This is what we're doing here at Deep Knowledge Group, right? So we do analyze different strengths, weaknesses, opportunities, and risks. This is pretty classical, right, approach how to do that. So you can take a look on the slide. But again, if you're talking about modern approach to SPVs, that's very different from how it was done a few years ago. And if we're linking it with fiduciary business, eventually big companies like institutional investors, qualified investors, private equity houses like Blackstone, right, Partners Group, Riverrock, etc. They even consider purchasing their own fiduciary companies, those companies who actually service SPVs, right? Because it is proven to be a money well, right? You can find yourself some companies on the stock actually, and you can see how their stock evolves during the crisis. And that, it's pretty strong business, even though it's pretty demanding in terms of investment, creation of it, and maintaining. But what we are focusing here is to create something new at Deep Knowledge Group, right? We try to implement new approaches, how to actually make complex things simple, how to provide those investors who would like to cooperate with us to find their portfolio companies, to find how to work with different startups, to how to fund them, how to maintain good relationship with everyone, how to provide them simple solution that will be mainly automatic, that it can take less time, less efforts, and less money. Because first of all, being an investor, you think what about? You think about your money, right? And the more money you have, the more concerned you are about your money. Therefore, you can see here on the slide like different methods of companies, how it was financed, equity, debt, hybrid instruments, etc. And what we are seeking to do at Deep Knowledge Group is to provide, again, maximum opportunities to flexibly set up your structure, right? Irrelevant to any jurisdiction, you may have different instruments, how you would like to set up the investment portfolio. Being in the UK, you would like to have different hybrid instruments, convertible notes. Being somewhere in Europe mainland, you may have equity investments, etc. So again, it's up to you, and we would like to provide these opportunities still remaining, cost efficient and growing in line with current tendencies in the state of art and technology side. So again, venture capital mechanism is very different, and it evolved quite a lot since few years. And again, feel free to take a look at the slide. You see that usually when you talk about investments, you can take about angel investors, venture capital, private equity, and then exit at the IPO, right? But there are new routes how you can find investors, how you can structure deals based on crowdfunding and public funding. You can have syndicates of investors, you can have specific fund of funds investments, you can have SPVs, you can have different approaches. You can even find a way how to get, qualified investors and a mix of qualified, non-qualified investors, like retail investors, still being in line with current regulation and compliance side of the things. This is a brief, comparison of popular platforms and deals, how they close those deals in comparison to investors onboarded. Right, this is the same, but in comparison to startups they work with. And eventually, at Deep Knowledge Group, what we're trying to seek is the best and optimal solution, how to connect private investors, small and big investors, with companies that seek for financing, how to help them fundraise, how to help them present themselves, and how to help them make and create awareness of themselves, right, with respect to different investors on the market, and reach different countries, different jurisdictions, different portfolios, and more efficiently. So I believe you've seen this slide also in Dominic's presentation, so I'll skip past it. So in order to accelerate investment deal flow, right, we're setting up our own know-how, how to do this. We have gathered already a lot of information, and we would like to actually create out of raw data something new, something valuable. We would like to provide our clients, those being investors, those being fund managers, those being portfolio companies, with a specific value that no one else can. This is our aim, and I trust we're doing this to the best possible extent at this moment, having specific IT solution and specific legal know-how. So these are the key services that we are aiming to provide and already provide to our clients to the best possible extent. Right, these are our competitive features that will increase our value in eyes of our investors and also in eyes of our clients. And eventually, I would like to also make a reference to our big data analytical dashboards, right? This is a significant product that was developed by our colleagues in Deep Knowledge Group that actually brings us to the key point of our approach, that we try to gather as many information, as much data as possible, and then process it in the most efficient way to provide a result, right? So feel free to take a look, feel free to reach out to our team members to discuss more about this. And this may be also a significant tool for you, for your own research, for your projects, and even not if you're interested in SPVs, but you may be very interested in our dashboards. That will be my end, and I hope to meet you soon at the panel and have a further fruitful discussion. Thank you.
Nikolai, thank you very much for your time and for your presentation. And of course, we will be coming back to it later during the panel. Ladies and gentlemen, I think it's time that we will take a very short break. We will return in just a few minutes. For those still with us, please do feel free to catch up in the chat box below as well. Feel free to network, to share your details and your contact details. As mentioned, we have been proactively sharing links and profiles throughout today's conference. I would also ask you not to be shy and to please send your questions in the Q&A box just at the bottom as well, if there's anything that you want to have us expand on further or to discuss. So we will return in just a few moments, where we will be hearing from two more very distinguished speakers. We have Thomas Hyder from Microsoft and also Dr. Eric van Dijk. So yes, we will have a short break and see you in just a moment. Okay, we will return in just a moment, but I just wanted to take a second to go through some of the chat and see who we have and where you are all from. So we have people from the US, which is great, Ohio, West Coast, Sumer Chopra, back expert from Mazars in Luxembourg. Hello. Hello, Anastasia from Dubai. Ryan from Ohio, Rustam from Azerbaijan. Hello. And Vladislav, hola from Madrid. Hola from Yorkshire, England. Hello, Iman from Brazil. Max from Kazakhstan. Wonderful. We have so many people here from all corners. Anthony here from Uganda, looking to launch a deep tech IP commercialization program. Amazing. I think it's great that you're learning a lot from this conference, and I hope you're finding it useful, valuable, and that you will be able to use it going forward for your startup as well. We have Kija from Tanzania, Victoria from Munich in Germany. Wow. Really, really impressive. And thank you again to Tanya and also Katerina, who are behind the scenes sharing all the details and information as well. What I would ask just before we continue on to our next speaker is please don't be shy and please send your questions in the Q&A box below. I do have a set of questions myself that I've been noting as I've been reviewing the presentations. I think it would be really interesting to have questions and if you are new to this space and you don't necessarily have the same background, but it's something that's interesting to you, then please feel free to ask a question that might be useful and helpful. And we have a lot of people in the audience who are here to learn for products that they're launching and who are new in this space. So please feel free to ask anything that could potentially provide you with some valuable assistance in your future endeavors. And also, if you are experienced in this field and you maybe don't agree with something that you've heard, or perhaps you would like them to expand further, then please do, again, ask in the Q&A box below. Okay, with that said, I think let's move on to our next speaker. First of all, I just want to check, Dr. Van Dijk, are you with us?
I'm here, yeah.
Oh, hello, hi, hello. Lovely. Okay, so I will introduce you. Wonderful, we have you on camera as well.
Thank you.
Lovely. Okay, so now that we've had our break, we're all feeling a little bit refreshed. Let's welcome for our next speaker for today, Dr. Eric Van Dijk, apologies, who is EMFM Advisors and Parmenian, is that right?
Yep.
And so your topic today is value creation via InvestTech, digging deeper and deeper and deeper and doing things differently. Dr. Van Dijk started his career as an academic in Amsterdam and at the University of Chicago. Here he created the basis for an innovative quantitative investment management system together with, now this is wonderful and very impressive, together with Nobel Prize laureate Dr. Harry Markowitz. And I believe that you collaborated on a paper together as well, which I think we might have information to share below in chat. Dr. Van Dijk then left the academic life to create, well, his academic life at that point to create a startup company via which financial information about equity markets and output of the quantitative investment systems was made available to smaller institutional and ultra high net worth investors. After about 15 years in institutional asset management, he then moved on to focus more on his proprietary investments with a special preference for emerging markets and selected tech investments. Dr. Van Dijk's focus in investments has always been on fair growth for the long run at a reasonable price. Dr. Van Dijk is also a specialist in Islamic finance. Is there anything that you haven't done? I do wonder.
I've done the whole circle, I guess, but that's the advantage of being old. Huh? Then you have the time to do the whole circle.
Well, I'm very much excited to hear your presentation, and the floor is yours.
Okay, thank you.
Thank you.
So let me start by sharing the screen. So let's share it. And let's do this from the beginning. So yes. I hope this works and you can see my screen now.
We can see, yes, we can.
Yeah, So basically, when you asked me to do the presentation and I was honored by it, I thought, okay, Investec, you can interpret that in a lot of ways. On the one hand, there's the word investing in there. On the other hand, the word tech, and there's a lot of tech investments from medtech, fintech, consultech, edtech, et cetera, and they all need investors. And there's, of course, Investec, the word which really limits itself to, let's say, a subsegment of the fintech market, namely solutions for the investors, the institutional investors, via which they can then enhance the return corrected for risk that they can make on their portfolios. So basically, when asking, okay, what direction shall I go? And knowing that you would have such a diverse audience, I thought, you know what I do? I go for the smallest of these possible ways of defining Investec, namely the Investec as the subsegment of fintech, namely how to sell things to the guys that in the end will, for everybody in tech, be their investors as well. Because a lot of people always forget it. Venture capitalists, private equity parties, they don't have money. Behind them is always either an institutional investor with money, a pension plan, a sovereign wealth fund, or family offices, ultra high net worth type of people, of whom I'm now happily one of them. But in the past, when I started, I was just a professor knowing a bit about tech and quant and this kind of stuff. So this full circle there has helped as well. And I thought that what I can give the audience then is this inner look about something that is, for many people so far away, so much opaque, obscure almost shrine, where they think, how the hell can I sell my stuff there? How are these guys approachable? Well, they are, but actually it's not about digging deeper and deeper. It's about doing the things that you have in mind differently. That should bring you from where you are to the next spot. And why is that? Well, actually, think about this here. Venture capital firms, the LPs, is the guys with the money. And the guys with the money seem to invest less in wealth management related fintech than in other types of fintech. How is that? So the ones who really know the situation where the venture capital firm has to convince a client who actually is the customer of this specific product as well, is the lagging part of the whole tech development. That's weird, because you would expect that if they really have to put their money into something that they know because they will be the users themselves, that it should be an easy way to get money for that. And somehow it's lagging. And I find it weird also because, when I was a professor and did a fintech in a way, avant la lettre startup back in the end of the 1980s, using the new technology called email and floppy disks to bring financial information to ultra high net worth and small institutional clients. It took me a couple of years, and a big insurance firm bought our little firm. So was that because it was simple? No, because don't forget, in those days, email and floppy disks was just as much fintech as the more sophisticated stuff now. Never forget, what is rocket science to the outside world is daily use stuff for the rocket scientist. So there is something fishy about this thing, that the big potential users don't seem to buy a lot of stuff in wealth management space. So there is a mismatch there, either in language or in the way the parties with good products try to sell it. And I hope to take you through slides that may help for any one of you who tries to sell to big finance in getting their attention the right way, so that you either get funding or maybe sell your product to them, because both are, of course, possible. So here's a slide in between, which actually was not in the one that you have, so you get this updated version from me. It was the result of a little dialogue I had on LinkedIn with a couple of outside people that felt that they had the fantastic product in the world and that it should be bought by the big institutional investors. I made a little exercise here saying, okay, suppose I make 10% a year, that's the first column there, on some kind of institutional equity product. Then after 10 years, this has grown to 2.5 times the initial amount. So if you say that you bring some kind of InvestTech type of product that does 5% better, yeah, you are a little bit further after 10 years, namely at 4. So, okay, you can sell something to this institutional client saying, hey, I can make 5% more than what you're currently making. So this is quite interesting. And if they will then say, yeah, but if it's so great, why don't you use it yourself? You can say, I'm too small, because after 10 years, it's just 1.5 times added compared to the 2.5 that you make. I'm 4.04 times the initial amount. And yeah, my amount is so small, doesn't make much money to me compared to what it does to you. But that's not what happened. I mean, that's a feasible strategy and it makes sense and the guys would listen to you. But what you see very often is that people say, hey, I'm this offer you can't refuse product that I made. It's artificial intelligence. It's a lot of rocket science and it's fantastic. And I dig through a lot of daily data and I can make 40% a year. Now, suppose that's true. See how quickly after 10 years, this amount of money that you have goes up. So suppose that it's really true that you sell me something that makes 40% a year with the same risk as what my strategy with 10% a year is doing. The 2.5 has become 28 after 10 years. And you often see people 25, 35 years of age who then say, yeah, I can make 40%. But if that's the case, why don't you go to your bank, borrow whatever money you can get, and don't bother me with trying to sell your product, right? Because it doesn't make sense. You're either a lousy entrepreneur or you're lazy and you don't want to start a business. Because if it's so much better without additional risk, you should do it yourself. So the moment that you have in your business model where you try to create a tool for the big finance guys that is fantastic, make sure that you know this math. Because if you're very young and you're 25 and you will do this thing 20 years, you would never even need an investor. You would just do it yourself and be very well off. Look at the situation after 20 years. So this is a first warning. And it always happens. You still see it a lot, that people try to make an offer that the big investor cannot refuse and forget that if you do the math yourself, that the offer that can't be refused is an offer you would never bring to big finance in the first place, but you would start exploiting it yourself. So this is just something for you to keep in the back of your mind when we go further. And there's another one, and that's one that actually popped up the other day when on LinkedIn, a guy was basically attacking my old friend and partner, Harry Markowitz, for saying MPT, modern portfolio theory, is stupid. I'm this 25, 35-year-old guy, and I had 4 or 5 good years, and I can easily beat the market. Well, okay, but then this exercise. If you have 1 million investors, each of them without any strategy, they have, let's say, a dice-based strategy and 50-50 chance of beating the market. Let's say their strategy is that in any of the years they will buy long or short when the numbers are 3, 4, 5 versus 1, 2, and 6, something like that. Sounds sophisticated, but it's not. It's just dice throwing. It takes 21 years and you're still left from this 1 million people with one guru star who beat the market in every year. So this guy has 3 business cycles, every year outperformance. So probably already a lot of followers. But don't forget, the next year, he's again throwing dice and he's just as stupid as the rest. There's a 50-50 chance of him to underperform. That doesn't change. So the fact that there are so many providers out there who want to get to the big finance, with big finance knowing very well this story, means that the moment that you try to go that direction, you already understand why it's so hard to get their money. because they keep this always in the back of their mind. Now let's see, because I'm definitely not pessimistic for anyone who tries to sell to big finance. I think it is doable the moment that you talk the right language. So InvestTech, as the combination of any technology and strategy that you could use to help investors get better risk-adjusted returns, that is indeed something where big data and AI may have a role, but it's not the buzzword that immediately would get them horny. Actually, there's not so much that immediately gets big finance horny in the first place, because they are very, very risk focused, and they have to be because their clients are incredibly big. Maybe one nice anecdote there. When I sold my firm to this big insurance company, and I brought in a guy that was with me in the university, a fantastic, brilliant scholar. Our first client was a pension fund that gave us 250 million guilders in those days, which is still a reasonable amount if that's your first investment portfolio that you're going to work on hands-on. The guy was great in university. The moment that he had to buy real shares, he couldn't get away from this feeling, oh my God, I'm buying this relatively tricky technology company with high volatility. Oh my God, what if it goes wrong? So he kept on thinking about, what if it goes wrong? What will Eric think? What will the bosses think? So somehow it was in his mind that the size matters indirectly, as in saying, yeah, but with big amounts of money at stake, it's different. So the guys in big companies, especially also because the third-party providers of that money are powerful institutions themselves, they don't think in terms of buzzwords, but they sound often very skeptical. They do definitely believe in technology, but don't make it sound like buzzwords, because you really will see that the fence between you and them will go up. But deep down the line, it's much simpler than you think, because net risk-adjusted returns being higher than what they have at the moment, well, that could be something where you need rocket science and AI. But if it's something that could help them reduce their cost levels, for instance, something simple as, let's say, you create a website where you have YouTube movies of 20, 30 minutes with the same kind of questions that they find important with every CEO in your universe, they would love that. And that's very simple. If you have 100,000 stocks, just try to get 100,000 CEOs with little movies and get some storage for that. And it would save them 1-2 trips where they would visit potential candidates to put in their portfolio, simply because they could have the CEO answer their questions whenever they want to have the answer. Because it's quite a hassle to get CEOs of stock market listed firms on the phone at the time that in another time zone, the institutional investor wants it. That's not a rocket science product. It's one that cut the cost by saying, hey, if we have such a product, we would have to travel less and would have less coordinative costs in terms of when can we talk to the guys. So such a kind of simple product could be a fantastic hit with big finance. And that is, in a way, why in payment systems and payment services, you saw a lot of fintech succeeding. Because it was far clearer that the guys who created the tools or the new products understood what was worrying the big investors. But here, small, simple, different could be keywords just as important as big, more, deeper, etc. But let's start then doing the same thing. How big is big? Here you see a few pieces of data that there is gigantic amounts of information out there. All the numbers are in the thousands, hundred thousands, millions, billions, and even terabytes. And the big institutional investors in most places in the world deal with already, in terms of investable space, 150,000 companies as well, and a multiple of that in private company candidates. So yes, there is an enormous amount of information out there. Now, shouldn't that be so compelling that you automatically then sell anything related to making big data available? No, because I give you an interesting piece of research that was brought to market a couple of years ago by Robeco, the big asset manager from the Netherlands. 3 of their quant researchers wrote a nice piece about what they called the conservative formula, which is a very simple equity strategy using 3 pieces of information that everybody has at their disposal, even if they have something simple as Morningstar, Simply Wall Street, or any other data service. The only thing needed is volatility, momentum of the stock price, and dividend yield. And basically the strategy said, first, get rid of half of the universe of stocks with above average volatility. Forget about them, too risky. Then with the half that you have left, say, okay, now let's get rid of the 50% with no or low dividend yields. So take the highest 50%. And then last but not least, get rid of the half of that group left, which has the lowest stock market momentum over 12 months. So pick the ones that have the best looking charts over the last 12 months. Then you are left with 1/8 of the companies that you initially looked at. And if you create a portfolio using this very simple strategy, well, it's very nice to see you would outperform your market universe relatively simply. Not by the 20, 30, 40% that I showed in this food for thought slide before, but you will beat your universe. So the big investors who basically have oil tankers to steer and not speedboats out there know that there are a lot of relatively simple algorithms available that could help beat the market. So more could be interesting, but not necessarily the way to go, because simple might already get people a pretty long end from where they are in terms of creating outperformance. That may again sound that I'm somewhat skeptical there. No, I'm not, because if you look at what is internally in there in tech, there's 5 elements that are really very interesting to the big investors that are part of, let's say, the end clients of anything fintech related. Analyzing behavior and finding patterns, that's what quant investors do for a living day by day, and even fundamental investors who are not quant, they love to have better and more information about patterns and behavior, as long as it's proven that it works and manageable when trying to incorporate it in one or the other strategy. Multiple data source combinations, for sure. I mean, if I have segregated data about A and B and I can combine them to create C, of course, that's very useful. Just one example, suppose you have great information about a country, let's say China, and you have great information about a certain sector, let's say health, then information about A and B that can be combined into some kind of easily written, predefined report about the Chinese healthcare sector. I would love that. Tell me more about it. The third one, less sexy, but definitely important as well. One of the problems with big finance, why they can seem cocky and a bit hard to approach, is that big finance doesn't mean bigger as in having more clients. That's banking talk. But big asset managers can be big because they serve big clients. So it's actually a very small world, and customer service is not that complicated. I mean, I've been in conferences in Switzerland, for instance, where half of Europe's institutional money was in the room. It's possible because with a couple of 100 institutional investors of big sizes, that's doable. Take, for instance, in my old home country, the Netherlands, APG, the #1 pension plan, has a size in assets under management of approximately half of the GDP of the country. And if you add #2, which is taking care not of the civil servants, but of the people working in healthcare, PGGM, they have 25%. So these 2 institutions are good for 3/4 of national income of a reasonably sized European country. But they don't need to serve yet those small customers because we have a collective pension system. However, and that's nice that we know that now from the US, the 401k, where people individually are taking care of their pensions, it has certain advantages. And in Europe, more and more countries are looking into individualized as opposed to collectivized pensions. Now, then the customer service starts becoming very important because you can't have all those people in the room and you want to tailor make things. So basically, that taking with us to the next slides means that improving customer service is an area where it might not even be so complicated to provide interesting InvestTech related services to the big giants. Generating additional revenue is then automatically linked to it, because if they can handle more smaller clients without a lot of extra cost, well, they might consider it. And last but not least, it could help you to be more responsive to the market. So certain markets that are segmented or hard to cover, yeah, with certain software opportunities, it could become possible to do that. Look at, for instance, the success of online brokers like Interactive, who started in the US and now basically offer their services in many countries, bringing international investing closer to the people. So in the end, size, yes, matters, but size is something that can work against you when trying to sell to the big investors. But you should make it something that works for you by talking their language and offering the things that they really want to see. So to cut this slide a bit short, because I already explained quite some things from it, it simply means that you first have to dig very deep into what big finance wants. And yeah, I think that InvestTech wealth management is the most complicated area there, because a lot of people were never managing portfolios of incredibly large sizes. So it's very hard to then talk the right language. When you try to talk as if it was your small portfolio, well, the smaller you are, the less your portfolio management looks like that of the big giants. So of the various fields of InvestTech, which are the ones where you have the best chance? And it's actually nice that Dimitri yesterday gave us a hint in that direction already. The areas where you can see that the biggest success was created is, for instance, feeder funds, portfolio aggregation, and yeah, new kind of products that would enable the creation of various setups that would enable big parties to work with smaller parties. An example is, for instance, what Vauban is doing in the UK, where they are able to help people set up their own fund or feeder fund that could then collaborate with the big giants, and the big giants could work with you as an intermediate layer without having to deal with all the small clients yourself. So whenever you would then be there with an interesting product that would make such a thing more cost effective and more tailor-made, so that the big party would say, yes, I like to work with this party because of this structure that was created. Then if you can do that at a low cost, because intermediation means an extra layer of cost, of course. So when the costs are minimized, so it's not a lot of extra work and not an extra layer of cost so that the end client would be disappointed, then this is an area where a lot is possible. So in a way, to summarize, there's like, yeah, the 4 Ds of InvestTech, you could say. The first one is definitely a go for all of us. There was this democratization as a result of which anything related to tech in terms of computer power, memory, etc., became so much less costly over the years that it is becoming B2C more than B2B, simply because anybody could have certain applications now on their smartphone or laptop that in the past was only available to the big finance guys. And I like to give the example there of Simply Wall Street, an Australian little startup financial platform provider, which has a database with 150,000 companies, fundamental information in English language. It's a nice database. It's basically almost everything that a big institution would have, except that there's not real-time price information, but a couple of times per day, but more than enough to do something nice with it. I actually work with them and I created a couple of institutional style models to communicate with their databases. And I can only say, yes, you can run an institutional strategy on their platform. So if it's good enough for our size portfolios, it's definitely good enough for a small investor. So these guys did something great. But the funny thing was, they did something great without knowing where it would take them. Because when they started people to try the product there, they said, yeah, you know, we start in Australia, New Zealand. And from Australia and New Zealand, we will then try to conquer the UK, Canada, US, because that's where people speak English. Well, they already got a little surprised because in Singapore, people speak reasonably English too, but they forgot something completely. The moment I last saw their update on how things were going a couple of years ago before COVID, they had a couple of 100,000 clients. Now they have 4.5 million. And you know what the big difference was? 4.2 million middle-class Indians who like to invest internationally and who love their service. So India became their prime market, and they haven't given that a thought when they created it. If you have English language and you talk about investing in technology, don't forget India. It's the biggest market. So that was a funny democratization where the middle class in an emerging market is already really changing the total picture. So don't forget emerging markets when you think in terms of democratization. Dissemination of information, yes, a lot of people are busy in that direction. They think that more data, bigger data, more has value. It does, but because there's so much noise in the market, you really need to be very, very, very big to really make a difference in that direction. But when you are an outsider, how to really convince the insiders that you as an outsider are good enough to give them the things that their army of PhDs didn't find. That's tough and difficult. And the moment you do, like in my case, and you were lucky, then the first thing they do is not buy your product, but buy your company, because they can't have the key man risk that you as an outsider deliver something that they are going to use on clients of 200 million in size. So it can happen, but then your company is immediately sold. The third one, disintermediation. Yeah, I mean, if you can create a tool that will help the big guys to do without an intermediate layer, then we're talking, because the intermediate layer is a hassle because the end client will pay more and they will have to deal with an extra layer. So if the things that you create in your company will enable them to serve more people at a relatively lower cost and give those people the idea that their product is tailor-made, whereas actually they just run the big portfolios that they always do, then in such a situation, this intermediation is fantastic. And last but not least, the dispensation. Big investors are not against small clients per se. They just think like this: okay, if we have to lower the fee levels to make it feasible, because don't forget, they don't believe in 30-40% returns a year. So if they think, okay, let's assume that we can make 10-11% and the small clients can pay 0.5 to 1% per year more than the big client, maximum, then to make it interesting to really throw dice with a reputation to get extra small clients on board, well, then it really needs to have as a goal a multiple times X% more clients. Otherwise, I wouldn't go that direction. And so basically, you really have to have, like in the Simply Wall Street case, the story of bringing people something at a low price. They charge $150 a year, Australian dollars, for something that with a Bloomberg terminal would cost you 20K. So in this comparison, you are creating a tool that could enable the big parties to really go the extra mile. So there are definitely possibilities the moment you have the right type of product at the right moment. Also, and this is something you all know, so I wouldn't bother you too much with this one, all the big companies in the world, all the big nations, even the average guy in the street, they all are pro-tech, pro-ICT, and everybody is convinced that the things can work for them at their level. But make sure that what you offer to a certain party is indeed what the party is looking for. And too much is going bust because of this mismatch between what the end client wants and what you have to offer, especially in those cases where you forget that the end client who needs to use your product is actually also the one investing in you via the venture capitalist. So that makes the financial industry a bit more complicated than other industries. So we are only at the beginning of this stairs here. A lot went wrong in, let's say, the first 20, 30 years of quant finance. So we saw growth, but not to the max. People are getting better and better. ICT is getting better and better and more affordable, where we see enormous growth in ICT capabilities in countries in emerging markets. And I actually think that that means that the countries where really, if you have a good fintech product, or if you are from such a country where you could really sell to interesting parties, is in emerging markets. But the fun is that everybody wants to sell their fantastic fintech product to Goldman Sachs or to Dimensional or to Vanguard. Yeah, they're very big, but they also have armies of people internally to create the stuff because they don't like key man risk from outsiders. On the other hand, they also know that 5 to 10 years ago, they had very nice clients from China, like Agricultural Bank, China Asset Management, those kind of big Chinese parties, because they were managing their US and European portfolios. However, at the moment, they're losing those clients. China Asset Management, ICICI in India, and all kinds of other big parties, Haluk Bank in Kazakhstan, they're doing more and more themselves. So if you have now an interesting product, why not talk to the big partners for the future in those countries? Because they are in countries where they don't have this old money, old network, etc. So they're far more open to new technology and new things. I remember that a long time ago, now almost 2 decades, when we didn't have any payment by debit cards in the Netherlands, that Kenya had it before we had. So you could buy in Kenyan supermarkets with your debit cards, and in Holland you still needed cash. So why was that? Because there was no infrastructure to start with in Kenya, so there was less disruptive costs compared to where the big giants are. And I think that this is the positive side of the story in fintech for anyone who is from an emerging market as a creator of fintech products, or who is working in the industry, in the financial industry, in an emerging market, and is looking for interesting products. Now, the business development managers of the interesting companies, they seem to flock Silicon Valley, they seem to flock New York, but they forget the interesting opportunities in Beijing. And if you don't want to go there, then try Singapore first. You can reach out to emerging market-based parties, but do it. So in a way, yeah, this slide is my feeling of the industry, having seen it from all sides. This little, very tiny cloud, how to influence investment behavior, is what most people are focusing on. But the big clouds, with all the other type of not so sexy and exciting products, is where there is enormous opportunities. And I pick out one just to give you an example. The one below, AML and cross-border fear of FATCA, the know your customer kind of stuff, that is an area where I do now see that there is a far more activity going on and a growing interest and actually success by parties offering that kind of less sexy stuff, simply because the big asset manager would say, hey, if I have these kind of tools and my risk of getting some kind of penalty from the regulator goes down X%, that can save me so much. Hey, it might be just a tiny little improvement technologically, but it could save me 0.1% in total return. But 0.1% on the size of the portfolio of the big client could really go a long way of your company becoming an incredible success, taking into account.
I'm so, it pains me to have interrupted you, as I feel like I could literally listen to you for hours and hours and hours on end. That this is extremely fascinating. But if I could just kindly ask, because we have another speaker that we need to go to as well. And so again, my sincere apologies to interrupt. If I could just quickly ask if we could just maybe look at concluding this.
Actually, you are a little bit quicker than I, because I'm there almost.
Okay,
Namely, it's very simple.
I do apologize. And
No,
we can,
that's
of
fine.
course, continue during the panel as well, for sure.
No, see, the good thing is the moment you are an old school guy who likes the Q&A to be interactive, then any interruption is fine. So also this one. So I would like to summarize saying, is it logical that the sector is critical of InvestTech, and that we saw in wealth management so many disappointing results compared to the regular fintech on the payment services side? My conclusion is yes. Will this change? Absolutely. The good providers who talk the language of the investors will definitely have enormous chances to be successful. They often are a little bit afraid of regulatory kind of situations, and they find it hard to incorporate them in their product. But the moment you understand how regulators work and understand that for the investors in big finance, the regulator is not something scary, but that's the group of people that you drink coffee with whenever you have a question. The moment that you keep that in mind, then helping them in making regulatory constraints not binding is really something where there could be products already. So that being said, and knowing that there is a gigantic growing market in emerging markets will translate into, I think, a positive story also for the creators when they are from emerging markets, because I can imagine that if you are a technologically driven great company in, let's say, Estonia or Ukraine, that it's far harder to try to sell in New York than it would be for you to sell in, let's say, a neighboring other emerging market. So it's, in the end, and that's on the positive note, good for all that we have a world that is changing, and where the moment you talk the right language and go to the right potential client for your product, you can definitely sell tech way better than you think, but keep those things that I just addressed in mind. Thank you.
Thank you so much, Dr. Van Dijk. That was absolutely fascinating and inspiring as well. As I mentioned, I could sit here and just listen to everything that you're saying in your presentations all day. And I think I probably will do at another one of your conferences for sure. So we will have a panel very soon. So there are a few comments and questions that have come in from our audience, and also from our panelists as well, which I'd like to address to you later. If I can just quickly move on to our next speaker, our final speaker for today, if I may, and that is Thomas Hyder. So welcome, Thomas. Thank you so much for joining us. Thomas is a principal in data and AI at a very small boutique company called Microsoft. Right?
Thank you.
I actually joked. I made that as a joke earlier. And
No, this is okay.
I think it's quite fitting. So Thomas has over 20 years of experience in technology and transformation, and your specialism is in technology, specifically artificial intelligence, machine learning, advanced analytics, and big data. And you are also experienced in working in venture capital, building global virtual teams, and driving global business strategies. Thomas, I am very excited to hear what you've got to say. I think you've got a lot of passion and are very much a technologist at heart. And I think it's a lot of what's going to be coming from your heart that we'll be getting from your presentation. So off you go.
Thank you very much, Roxy. And thank you for your points, Eric. Democratization has become key. And for a lot of stuff you're doing today, you do not anymore need developers in the amount you needed it times before. So a warm and welcome and virtual welcome from my side. I'm Thomas Hyder, a principal at Microsoft. Background 55, married, one daughter. Now my hair has become sterling silver. I'm getting old, and it's I learned a lot, and at Microsoft, AI and data and all, let's say, the stuff I'm doing has become key. And one thing first, as long as you're not doing gaming, there is no competition for Microsoft. Microsoft will not stop Xbox. Yeah, so I have also an Xbox, but we do not monetize any vertical businesses and like finance, healthcare, manufacturing, and so on. My interest has really become artificial intelligence, and what I want to do with you today is to take you on a journey into the world of artificial intelligence. And to start the journey, we need to differentiate what is analytics, what is machine learning, what is prediction from artificial intelligence. Then I will give you an overview of our AI tools. Okay, how are you doing this? And I won't do a demo, but I will do a short explanation what we have done with artificial intelligence. Yeah. I had the pleasure in 1993 to meet Joseph Weizenbaum. His program, ELIZA, was the first program to master the Turing test. So the Turing test is passed if a human on the other side, and it was 93, it was just keyboards and a screen. And if the human on the other side cannot see, is it a man or a computer on the other side? And ELIZA passed the test by using a psychology imitation game approach. And the doctor is called Rogerian psychotherapist. I will provide all the links from this from my presentation in afterwards, so you can look it up. It was great. He actually hated it, and the thing is, why did he hate his own program? Because it's artificial intelligence. It's just a batch program. Yeah, and he was looking for doing artificial intelligence. And to start, what is artificial intelligence? I have brought you on a classic game. Hopefully many of you know it. It's called Breakout. You know, you have the pedal down here, and you can just move left and right. And you have a ball bouncing back and forth, and you have to prevent the ball passing your pedal and shooting it up. And it destroys then all these rectangles up here. Yeah. And games, oh, sorry, I didn't want to do this. Games are very good to master, to be mastered by artificial intelligence, because at the beginning you tell the AI nothing about the game. It just tries. After 10 minutes, you see the pedal going left and right, and it sorry, I do not must change this, and while going left and right, it misses the ball very often. But after 120 minutes, the same AI never misses a ball again. And I think this is pretty normal, okay, because it can understand, okay, it sees the ball coming down and it just has to place the pedal to the right place. But what happens on 220 to 240 minutes is this is astonishing. Don't know if you know this trick, grabbing a tunnel on the left or right side. If you do this, the ball passes by and goes up and down and destroys a lot of rectangles without you doing anything down there. And the AI just needed 240 minutes. I remember somebody told me the trick, and this is really, I think we are now 1990 or 86 when this games came out, and it was a cool trick, but there you see the power of AI. why are AI companies using games for checking how good an AI is? It's very, very good because a game has clear rules. You can make these rules, you can write it down, and it's easy to measure by the score. Yeah, you see it on the top side. The higher the score, the better the AI performs, and the use of these two measures then brings a very impressive result for Breakout on the one hand. And now let's move to two other games. Maybe all of you know the game chess. This is on the left side. And on the right side, you see Go. It's a Chinese game. Yeah, it's basically it's black and white stones. And if you encircle black stones with your white stones, every black stones within the white stones will turn from black to white, yeah, and vice versa. The difference is, see if you look into the details of the games. You have with chess, you have a 21st move options. With Go, you already have 361. The second moves with chess is around 400. With Go, it's already 130,000. And approximately legal board positions with chess are 4 times 10 exponent 44. And with Go, 2 times 10 exponent 170. So these numbers are hardly to imagine. Yeah, what is 10 or 4 times 10 exponent 44? To make it a little bit visible, the world or the Earth approximately has 10 exponent 50 atoms. The atoms in the universe are 10 times 10 exponent 86. And now to come to 10 exponent 172, you have to create a universe for every atom you have in the universe, and then count these atoms again, and you're close by 110 10 times 172. And there you see the difficulty. Because of the sheer size of the problem, mathematicians and informatic people were sure no computer will beat a world championship before, I think they said 2030, something around. The compute power won't be enough, yeah, because of the sheer size of the program. The IBM Deep Thought was beat by Gary Kasparov at 10 at this 10th Feb of 96. AlphaGo beat Lee Sedol. He's the world championship in Go on 15th of March in 2016. And it was crazy because some moves and it was really declassifying for Lee Sedol. Yeah, it was, I think, 7 parties of game, and he only won one of the games. 6 he lost. And here we see what is behind AI. On the right side, you see with deep thought from IBM, you see pure computational power, which reflects analytics, machine learning, prediction out of machine learning. You have mathematical regression. You can calculate it. On the right side, you have two technologies. You have neural networks and reinforcement learning. On the left side, you have a computer. You can stop the computer at any time, and you can look where in the code the computer is. On the right side, you have a neural network, and you do not see anything. One at the first party of the game between Lee Sedol and AlphaGo, the computer did nothing for 2.5 minutes. The programmers were sitting there and they could not do anything because you cannot look into a neural network. You see it's working, you see there's action going on, but you cannot understand it. And one crazy thing happened. I think it was in the 5th or 6th episode or round of games. It was in the beginning, and AlphaGo made a move, and all the people, all the high class champions of Go said, now it will lose because it did a wrong move. It did win, and the reason is no man has seen this move before, because what you're doing is, and what the guys from deep learning did at those times, they created a general AI who knows how to play Go. Then they duplicated it and let play it against itself. And so AlphaGo grew stronger and stronger. And this is, I think this is the big power. And please, I also want to if you bring in questions, what is it behind it and why do you think AI is so important? Please bring in questions as well. So I have noted down now the facts. We are talking about analytics versus deep reinforcement learning. On the one hand, you have, and this is chess, or let's say anything you can compute. And most of the stuff we talked today about, we talked about big data and analytics of big data and a mathematical way of taking the data, taking part of the data, making a model, and check the model with test data the model has not seen before. And if the model succeeds with 85%, okay, that's enough, we can take it. It's a universal use of historic data. So you use a lot of data, you analyze and rank data for the desired outcome, and you brute force analyze it. That's exactly what Deep Blue did. And the challenge for doing analytics, and now we are coming to the point. We heard a lot about also how to bring in factors from the outside, like what do customers want? You can bring in data from anywhere, but you have to classify it to make use of the data if you do analytics. And if the sheer size of the data is too big, it limits your model because you cannot anymore compute it. On the other side, you have deep reinforcement learning. You have defined rules and boundaries, which are clear to everybody. This AI, and I must be very clear here, is highly specialized for one job. And AlphaGo was highly specified to play Go. Yeah, and this was the beginning. So you cannot use this model for playing chess. At least this was the beginning, but you can do it as well. Today, I think no man has a chance to win against these machines with chess or with Go. They are too strong. AI learns by getting rewards and penalties. If you remember Breakout, it's a reward if one of the bricks is removed from your board, and it gets a penalty if the ball passes by and the game has to create a new ball. Yeah, and then you go on. And maybe it's limited by 3 balls, and you're done if you have lost 3 balls. And we have learned from AlphaGo, and this was the beginning. AlphaGo beat Lisa Dole. Afterwards, Google created AlphaGo Zero, which is basically they teach the system nothing, like Breakout. AlphaGo, the first AlphaGo had games from learned by redoing games which men and great Go masters have played before. But also remember, man is making mistakes. Yeah, so AlphaGo also learned the mistakes. AlphaGo Zero, if you bring in only the rules and say, okay, just start playing the game by the rules, you know, like in the Breakout thing, it will go very wrong at the beginning. But with simulation and playing together, it's a very strong method to learn. What will happen now? And AI, and also not to forget, it plays against itself. So you can duplicate this neural net. And now, for instance, cars, self-driving cars, they learn by driving in simulations. You cannot do the same breakout approach with a car, because then the car would crash into anything and it would destroy something. But you can do a simulation. You can let the car run in a simulated world and learn driving by itself in that simulated world. And then transport this into the real world. And it's only limited by rules and boundaries. And this is I think the challenge, the problem you want to solve needs to be able, you need to be able to formulate the problem you have, and to formulate the boundaries and the limits and the rules of the game. If you can do this, it works. Where are we going? At the beginning, and all of you know this, computers were very complicated. I don't know if you remember the times where you only had a terminal, and it was really horror to do any programming. Today, technology learns us. What AI also can do very good is imitation. It learns from what we are doing. It's observing, it can listen, and with all these points, technology learns us and discovers how it can help us. Because, and I think it was said before, I do not see AI as a danger. And I now do not use fintech, I use healthcare. If you use AI in cancer, in finding a cancer in an MRT, it can be very difficult because these MRTs are very, very large scans of your body, and it's easy for a doctor to miss something out. And what the AI can do there is just have a screening of the MRT and saying, hey, if you do not look anywhere, just look into this point, and that point. And the rest is your decision. So AI is like a helper on your shoulder. And now we are coming to the tools. Yeah. So what we are doing, and this is now on this screen, yeah, it's anything on there, from forecasting and anomaly detection also points in here are analytics. Yeah, so this is mixed up. It's not everything is AI here. Yeah, but if you look, for instance, into computer vision, this is AI, because you have to bring down an image, and you have to make the computer understand what he's seeing, what it is seeing. Sorry, it's not he, it's it. What it is seeing, and you have to bring it in with a neural net, because otherwise it cannot understand the world. And these are the challenges. Or what you also see is speech to text. You talk something into the computer, into the API, and what you get back is either you have pre-qualified the language before, or if you have not done it, the computer can also try to get your language. Maybe you all use these translators, and they have become tremendously good. I only can tell you to give it a try. It's a different world than 5 years before. Yeah, the translation power is very, very good. And speech to text, it works also very good. I personally dictate very often emails, SMSs. I do not type anymore because it takes too long. And the same goes the other way around, text to speech. I send a text to an API and said, I want to being spoken back to me by a woman with this with voice, and then I get an MP3 back and can use it in my program. It's a different way of using programs. And one example, and I cannot do the demo because we are time constraints here, is cognitive search. Maybe everybody knows the picture here. Yeah? It was taken on November 22nd, 63, and it's the assassination of John F. Kennedy. And yeah, the government now released 34,000 documents related to the assassination. They are printed on paper, so you basically have no information. And this is where AI comes in. And it's not only printed, it's also hand notes on it. It's photos like this here from Lee Harvey Oswald, and on the photo you see New Orleans, LA. So computers can read this, and they can give this information. They can understand it and bring it into combination. We have created a JFK demo. I will also add all the links so that you can try it yourself. At those times, we found out, we just brought in the 34,000 documents. Basically, it's all the data comes into Azure storage. Then the content is extracted. Cognitive skills are OCR, handwriting, computer vision, entities, and knowledge, because CIA, FBI, they have a kind of hidden language where acronyms are used. You also give the computer this to create a big graph of information. And then you can look into this information and you can find out. And we just typed into the search engine SQL, which is our SQL server. And we found out that the CIA used an SQL server plus Lotus Notes to store all the files and make it available to other government organizations. This was, and this is, you can find out information which is hidden to you. And that's also what I want to give you. The demo, we don't do it. And now I'm coming to the conclusion. What is coming and what should we be aware now? I think this technology can be used against financial fraud, can be used to support cyber security. We also do this internally. We have a cyber security division which does nothing than trying to find out all these frauds and crooks out there who are making bad things in the internet. Yeah. And you can automate personalized customer products, but not on data you already have. Maybe you can find, or the AI can find patterns you have not seen yet before. And another point is quantum compute, but this will then be another complete, let's say, post or lecture. And what's very important with AI is they should treat all people fairly. We have really put a lot of effort into using the use of AI should be safe for everybody. It should perform everything safe and reliable. It should respect privacy, and it should empower you. It should not destroy you. It should empower you. And one thing, at least we should understand the AI or what it is doing, even if we cannot see the program anymore. This is the big problem of with neural networks. You cannot look into it. It's a black box. And to finalize, yeah, this is not last week now. It's wrong. I need to fix it, yeah, because I made this presentation on 21 first. President Biden is still delaying the release of the final documents. So I hope it was interesting for you, and it was a different view on what's the difference between AI and machine learning and the analytical stuff we do most when we talk about prediction. Any questions?
Wonderful. Well, Thomas, I think we have several questions pending here.
Yes.
What I think we will do, I think we shall invite these questions for our panel. Thank you so much. That was very, very insightful and also quite thought-provoking. I think the last, obviously, two sessions have really delved quite, deep into sort of really thinking about AI as more of an art form in a way, and then obviously taking a more academic approach to it as well. It's been quite enlightening. So, right. It's now time for our panel. I will do my best to keep this short and sweet. So I would ask invite all of our distinguished speakers and panelists to please, first of all, turn on your cameras if it's convenient, and let's get ready to engage in some questions. Now, we do have joining us panelists who attended and were speakers for yesterday's InvestTech Innovations conference, which include Talgat Takiev from Longevity Financial Advisors and also Anastasia Litt from Deep Knowledge Group as well. So thank you very much for joining us. And again, thank you to all for your enlightening contributions and presentations. So I think I am probably going to jump straight into, I suppose, what we've been speaking about quite recently. So yesterday we had quite a few comments when it came to looking at AI from the point of view of trust and how we can sort of utilize it when it comes to decision making. And I see that we have had some questions in the Q&A box as well, which I think what we'll do is try to combine them, yes, so we can touch upon all these points. So my question here, will there come a time where we can trust technologies with investment decisions? When I say technologies, let's use AI as an example, to take on the risk, which, remember, in these situations isn't always calculated, and can be quite intuition-led. And will AI get to the point where people will not be needed here to fill that gap and to take on that risk. So I'm going to put that out to everybody. And what I would request is, given that we only have 15 minutes left, if we could please try and keep our answers as concise as possible, if it's possible. All right. So who would like to? I think Thomas, because we've just heard from you. Let's just jump straight to Thomas, and then maybe Eric, if you want to jump in as well. Alexandra, I think we've got a few comments here as well. So for sure.
Yeah, very, very, very briefly. I think trust is one thing, yeah, and it's like AI. Maybe it sounds like a person, and this is the problem about it. And like imitation, it imitates the good parts of us and the bad parts. So I think we need to closely look. We need to closely check. I think we will not be replaced by AI. So we are talking about highly specialized solution finding, because you need to define the boundaries of this. Yeah, and this is, I think, how can you define boundaries of risk? Yeah, so I don't want to lose money. Yes, then don't invest anything. Yeah, so then you won't lose. Yeah, and I think this is where man still is needed, and to teach the system. This is my personal opinion about it.
Interesting. Eric, what do you think?
I agree to a large extent with Thomas, but I would go one step further back, and that is that in the end, economics and investing is not rocket science, but prices are the result of transactions between people representing the entity that they invest for. There was a try to see if the computer could replace people already back in the 1980s, when a professor at Berkeley, Hein Leland, created portfolio insurance, a kind of risk management system which was totally automated. But actually it was a disaster because they forgot one thing. The moment that you let the computer do the whole thing, and the computer deals with other computers, and they all try to mimic what people are doing, and actually the people behind it don't incorporate that other people know, then in the end the system will fail, because the one who is really smart and who's doing his research will try to understand who is behind things in the market. So whenever you can make money in a small firm because the big guys are not investing there, this neglect is there, and the opportunity for the small investor is there, because the big guy can just watch and not arbitrage away the opportunity. So markets will always develop. And I do also agree, on the other hand, with Thomas, that if you would compare the market with a game of chess, just far more complicated than chess and Go, because this is not about win, loss, and a draw, but about any outcome from -100 to plus infinity, then basically the moment that you would leave in the market only very, very sophisticated things that would incorporate everything, then the only return you can score is the average. So everybody would play a draw against everybody. And that's what we already see in correspondence chess, actually. Far more draws than in slower normal games. So
I do want to ask you though, Dr. Van Dijk, you mentioned the big guy, and would you not say that we live and we operate in a business culture of wanting to save money and to automate? It's constantly, how can we save money? The big guy wants to save money in order to automate. And ultimately, that's what we're talking about, is creating a system by which we can automate the decision making to allow us to make investments and to better fulfill our investments. Is it a case that the only way to do it is in the technologies that would support the entities and these means, which I'm sure
I'm not in any way against the technology, and I like to use the chess metaphor because it links so nicely to what Thomas was saying. If you look at the developments in correspondence chess, where people are allowed to use the engines, that's basically what big investors are doing. They do have the computers, they do have the scientists, so they have created the algorithms that support their work, so that the moment that there's something special in the market that they never saw, let's say there is all of a sudden a development, and for the first time ever you see in a small African nation a unicorn in technology. That was not in the market in the old data. So their models could never know about this possibility because it wasn't there. So they need to look into the databases of other markets where they did have experience with technology unicorns, and not only with agricultural firms and traditional industries, etc. So someone needs to put that in the system, and people can easily do that. So the combination of good research by people and the computer as a supportive tool, that's definitely going to be the winner. And it's not one versus the other.
Well, incidentally, we have Alexander with us, who is a mathematician and a very, well-established analyst in that sense. So you would argue for the science and for that data input, I suppose, from your point of view.
Just a quick sentences just to add to everyone's opinion. So we need to understand what do we mean under this definition. Substitute the people when during the investment. So if we are thinking about a particular algorithm that can implement machine learning in order to conduct certain buy and sell orders, that's already in place. So we already do this, and this is we can say we already substituted if you want to, right? So there are certain solutions. The other question is, if we think, is it possible that machine learning will come up with new ideas and seen ideas in investments in order to create new strategies that were never seen before? In this case, I would say rather no, or not in the next 10 to 20 years. Why? Because in mathematics, we tend to do the same with ML. We just ask him to create new, I see, Jonathan, agree with me. So we ask machine learning to create certain hypotheses and theorems and try to prove it, lemmas and so on and so forth. And while mathematics is rather rigorous compared to the economy and finance area of study, albeit of this, machine learning isn't that great right now. And since economy is much more complicated and behavior-driven area of interest, I don't think it's of our capability, to do so. But as mentioned by Thomas, once again, if we would apply different computational resources, if we would move to quantum computing, probably there is some way to go.
Brilliant. And I'm going to ask Dominic and Talga, who we had yesterday. You both have very, if you don't mind me saying so, traditional backgrounds. And Dominic, you're seasoned with 20 years of experience in investor relations, investment management, working in boutique companies. So you've kind of witnessed and been sort of standing there with this, these frontier technologies on the horizon, and how they are going to really innovate or disrupt, maybe for the better, that's the hope, this industry in which you have solely taken on the responsibility with the decision making. So I'm curious how you take this and how you feel, from your perspective, it's almost like it's going full circle, and how you would respond.
Well, thank you. There's a couple of things I would say. One is that everybody, whatever time in their life, comes across the new. And it could be AI, it could be the computer games that Thomas was talking about, the old table tennis. I remember, I'm old enough and ugly enough, and I think I have to confess I've done more than 20 years. I can actually remember all those things, and I remember the original spacing, but it doesn't matter. It is still, everybody is faced with the new. And I think a good way to think, I've always liked investing and promoting the new, although I'm not qualified as some of these esteemed.
But we're not mistaking the new as a fad.
No.
It's the new as in something new that is going to basically set the standard and the landscape, right?
Yeah. Well, okay. I would say the reason I like this longevity idea and the whole industry and what we've been talking about, and they're all different facets, is 27 years ago, I was in Central and Eastern Europe. And that in 1995, half an entire continent in Europe, 3 hours from Heathrow, was living on $1,500 a year. Something had to change. You don't have to think about it. And we've seen for the vast majority of countries there have been tremendous developments and catch up. And when I look at demographics and deep tech and technology advancement, I see the same issue and newness in, somebody's ringing the bell saying there is going to be change. Something has to change. Now, I'm not qualified yet enough to say exactly how that will span out, but it has the same feel to me. There are plenty of other examples if you think this must change, but it's something new that seems to me to be interesting and fundamental.
Well, there will be an industry of professionals who will also have this same feedback and perhaps this same response that we also should consider when we think about innovating an industry and bringing in tech when it comes to investment and how it can support. We have to also consider the people who have been relatively holding that industry up. People like yourselves and Talgat, of course. Nikita, I know you've managed equity portfolios as well, but Talgat, I'd be interested to hear how you feel about this.
The one thing I would like to say without getting into much details, thank you. The technology changes are not happening right now only. The technology changes has been with us over the past probably like 120, 200 years. And the reason that we'll definitely get new technologies in the investments industry and so on. But at the end of the day, I believe that people's behavior is the most important thing in investments, and investments rise and fall because of the people's behavior. It all started like 400 years with the tulips mania, and it's happening. The same is happening now. 400 years later, nothing changes, but technology has always been advancing. So we should praise it because it helps us to gather information. It helps us with new tools. It helps us to understand some things much quicker than we could afford like 20 years ago. But at the end of the day, how we use it, how we approach it, it depends on the people and people's behavior. So it's a tool, basically. Like technology is a tool, but it will not like solve all the problems. Like I don't think it will like make perfect decision making and so on. Decision making depends on like people, and there will always be like mania, like it's happening on the markets.
Of course, it's a system.
Market cycles will always be there. That's like that's my opinion.
Absolutely. Nikita, as someone who has designed many sort of financial models and has worked in predictive analysis, what's your thoughts on this, on sort of disruptive tech in this area?
Well, if we're talking about, I don't believe yet in technologies that can make decisions, in technology that can maybe adapt. For example, all machine learning, all artificial intelligence based on data. What if data is not true? What if the inputs were falsified? Yes, we can say that technology can adapt even to these. That technology can. I saw a very interesting model that introduced matrix, which were converting the information matrix to just matrix consisting of even numbers depending on a level of uncertainty or something like that. So we can say that technology can learn even that, but I'm thinking that there should be a person who controls the environment, who controls the inputs, who controls the process, and then the models which are working for you would be the most efficient. The models without people, maybe not yet.
So I think that there was one question I just want to quickly go to, which came up in the Q&A, and I apologize to those who have asked a question and that they have remained unanswered. And I would encourage our panelists, if you get a chance, to type your answers in the box. But I'd be interested to talk about privacy. And a question that's come up, which is, how do you think data privacy should work in InvestTech? And it's interesting because I think this might, Nikolai, from a regulatory point of view as well, in terms of the barriers, the geographical borders that we have as well. Each country has its own, set of guidelines and rules. But I think we are maybe universally along the same sort of mindset. So if I can just have a couple of quick comments and words on how you all feel, maybe what it's doing now and how you think it should be improved and how data privacy should be worked and consulted. Who would like
Shall I start?
Yeah, please.
Yeah. Basically, I think that it's very important, and those who have done the CFA or know what the CFA is about know how the Americans have done it. They have, on the one hand, the legal framework included, so people should know the law, the regulations of a country, etc. But I find always, and I have taught the CFA courses in the Netherlands in the past, that in the end, the most fantastic part of the whole CFA course is that it also links to ethics. So in the end, everybody who one or the other way is a professional in this industry is also an investor, him or herself. So basically, and that links back to my other pet hobby, not chess, but Islamic finance. In the end, it is also about, what do you think the rules that are put in place do try to follow, in terms of where do we go and what would you have liked in the situation if you were there yourself. So basically, there should be one or the other kind of link to that ethics. If I am going to sell a product and do something with the data, where the moment I would ask myself, what if I would do this and do the same with the data for, let's say, my mother or my sister? Would the answer still be yes? And it's no, then that should be a very, very big red flag. And the moment that you would catch someone with that kind of situation, then I also like the fact that the US is the only one who has such a severe kind of framework that somebody who mistakenly does something against the ethical framework of the CFA, and who is a CFA, or even somebody who should know what the rules are about, will be punished accordingly. Whereas in Europe, you often see, well, he didn't shoot his mother, so in the end, it's just smart business thinking. It's not against the law, so it should be smart. And that's wrong. Because the thing is that in finance, we normally don't kill each other. But if somebody commits a fraud that costs 0.001% at the scale that big finance is operating on, it could technically do more harm for society than me killing my mother, in a way. And only the Americans seem to have really understood that.
Would anybody else like to comment, Dominic? Thomas? Oh, you're on mute.
Very, very briefly, I think it's not only privacy. Maybe somebody of you know that we have built a Twitter chatbot called Ty, with really a lot of followers. And the problem is that it imitated us. And it was bombarded with nasty comments. And it turned out to become nasty. So we had to put it back. We really had to roll it back and to destroy it. Yeah, because it was a creature, or I don't know how, an AI, a neural network, which cannot be used in any way anymore. And that takes us into, I think, the responsibility to use this technology for good, anything for good, and also good privacy and so on. And then this is the only comment I can give. I'm not a regulatory man or somebody who knows this stuff, but AI should be used for anything good.
Dominic?
Well, I just think so far we've proven that it's still men in charge, and they're the guys who operate and make these things. So it's going to be, as Alexander said, it's going to be a while until that changes, I would imagine.
Would anybody else like to add any final comments before we conclude today's conference?
Let me just comment as well that today we have many new investors, like newcomers, as retail investors coming, and eventually, like in the future, they will become professional investors. And for them, like these technologies should be understandable and they should be secure for people not to be afraid to go to invest, to use different tools in the future, and to go into to deep dive into the technology, into the field. So it's like tremendous nowadays, and as well as considering like the big data that is used for creating new patterns and models and creating new I believe like making new Nobel Prize winner theories that will become in the future, like we will discover. So in this case, like let's hope that AI and technologies that will be used for the better, and we will see the more interesting topics in the future to discuss.
Absolutely. Thank you. Thank you very, very, very much. I think with that final note on that, regardless of what it's been used for, we should always consult AI for good, social good, societal good, business good, and corporate good in any way, shape, or form. So I just want to say thank you to everybody once again for joining today's conference and the discussion. I found it really fascinating yesterday as well. Remember, we have completely recorded from start to finish these sessions from yesterday and today. These will be shared to everyone who attended, and I believe we'll also be able to provide to those who weren't able to attend as well. I would also encourage for our audience to visit our website for Deep Knowledge Group, which is dkv.global. Just Google Deep Knowledge Group and all the different links will come up, and you can find us on social as well. And you can get more details on our work, as well as upcoming projects and events you can get involved with. We have a fantastic conference next week on Tuesday around the same time. I believe it's on sustainability and food technology, about how we can build a better future using technology for better food sustainability. So that's a conference that you are still able to register for, which I would encourage you to please do so. Thank you to all of our speakers from yesterday and today. It's been an actual honor to have heard from so many of you and to witness some of the actual invaluable and intelligent insight from all of you. And your input has been fantastic and very valuable to us. I just have a really quick and final thank you to two individuals, Katrina Marilich, who has been our technical host and dealing with the logistics in the background behind the scenes, and also to the lovely Tanya Bell for sharing several and interesting links down in the chat below and the content for you to review, as well as Anastasia and Maria and the team who have helped put this conference together. It's been my absolute pleasure to have been your host today, and have a wonderful evening, everybody.